Hi, Cathy Sabater, mortgage planner and proud veteran. Today is Thursday, December 4th, and mortgage rates are basically stuck in the mid-low sixes. But the labor market just threw us a curveball that could mess with the Fed's next move. Well, let's break it down. What's actually moving rates today? Well, right now, the average 30-year fix is sitting around 6.25%, with the 15 years, right? 15-year loans, so they're in the mid fives. Compared to yesterday, pricing is basically a little higher, so no real big move, but we are not breaking down into the low fives, so call me to discuss buying down the rate. The 10-year Treasury is hanging around 4.1%, which is up 3 basis points from yesterday. So it's still providing a upward pressure on mortgage prices. And the big story today was the weekly jobless claims. The claims dropped to about 191,000, which is the lowest since 2022. But what does that mean? That means employers are still not laying people off in large numbers? I don't know, but a strong labor data like that makes it harder for the Feds to argue that the economy is in trouble, and that can limit how far mortgage rates can fall in the short term. Now, stocks are still hovering record highs, so markets are in a risk on mood. Now, some of the economists and traders still expect about a 1/4 point cut from the Feds at the meeting next week, but this is kind of strong data, right, from the jobs, means the Fed can take its time. But don't expect some magical overnight plunge from the 6-something% to 4%. Mortgage rates are steady in the mid sixes, low sixes, and the 10-year is firm, and strong data is keeping a floor under those rates. So if you're shopping or you're thinking of refinancing, this is a time to run the numbers, the market. Don't wait for a fantasy 3% market. So in the comments, let me know if rates tomorrow will be higher or lower.